When I think about wealth, I rarely imagine sudden successes or rapid rises. Most people dream of waking up one morning to discover that their fortune has grown by millions of dollars. But I know from experience that wealth that comes quickly can disappear just as fast. True wealth comes slowly, through patience, common sense, and an understanding of principles that haven't changed in decades. When I started investing, I didn't have a large capital. In fact, I began with small amounts that most people would consider insignificant. I bought companies that I understood, that knew how to make money, and that had real value, even if no one was talking about it. I often told myself, you don't have to be first to be successful. You need to be smart and patient. Understanding how capital works doesn't happen overnight. Many try to jump into the market, chasing the hottest stocks or trends, hoping for quick profits. They buy what they hear about on TV, what's discussed on forums, or what famous investors praise. I don't judge them. It's a natural human desire to look for easy paths. But in the long run, it almost always ends in disappointment. I learned to see value where others see noise. The foundation of slow but guaranteed wealth lies in understanding two things. First, the power of compound interest. Second, discipline. Compound interest works only for those who stay in the game long enough. If you let your money work for you year after year, if you reinvest your earnings, you'll be amazed at how quickly your capital grows. But the key word here is patience. This is not magic. This is math. Discipline shows itself in not giving in to emotions. The market will always fluctuate. There will always be news that makes your heart race. When everyone panics, it feels natural to sell. When everyone celebrates, you want to buy. But those who achieve stable wealth know emotions are the enemy of long-term profit. I learned to ask myself, if I owned this company forever, would I buy it today? If the answer is yes, then temporary fluctuations don't matter. Sometimes I hear people ask, but Buffett, what if the market falls? I answer, rejoice when the market falls. Falling prices are an opportunity to buy quality companies at a discount. If you see a crisis, you miss the chance. If you see an opportunity, you act wisely. And here is another secret of slow but guaranteed wealth, the ability to think independently. Don't follow the crowd. Evaluate the facts with your own eyes and your own mind. I can give a simple example from my life. In the 1960s, I bought shares of a small food company that most people ignored. No one mentioned it in the newspapers. It wasn't trendy, it wasn't hot, but I understood its business. I knew it produced products that people bought every day, that it had stable management and reasonable growth prospects. I bought the shares and held them for years. Compound interest and patience did their work. I didn't rush. I didn't chase quick wins. And in the end, this investment brought enormous returns. Slow wealth requires constant learning. You must understand where you put your money. Reading financial reports, studying companies, understanding economic processes. This is not boring routine. This is the foundation. I've always believed that the more you know, the less you risk. And the less you risk, the higher your chances of steady capital growth. There is also one more thing rarely mentioned. Wealth is not only money. It's the freedom to choose how to live, and the peace of mind that comes with financial independence. When you build capital slowly and wisely, you gain not only money, but confidence. You understand that your money works for you, not you for money. And here's the most important thing. If you want to become wealthy slowly, you must learn to enjoy the process. Every year, when you see your capital grow, every time you receive dividends or reinvest profits, you take a step toward your goal. It's not instant gratification, it's satisfaction from long, deliberate work. And this is what distinguishes real investors from those chasing quick luck.
Another lesson I learned early on is the importance of living below your means. Many people believe that wealth is built by earning more money, but true wealth is preserved and grown by spending less than you earn. It's a simple idea, but remarkably few follow it consistently. By controlling expenses, you allow your money to work for you, rather than disappear the moment it enters your hands. This principle may sound obvious, but in practice, it separates those who steadily build wealth from those who chase appearances and status. Investing is not a game of luck. It's a game of knowledge, patience, and rational decision-making. I've always said that the stock market is a device for transferring money from the impatient to the patient. If you are willing to wait, to study, and to resist the temptation to act on every headline, your capital compounds silently, almost invisibly, until one day you look back and realize you've achieved what once seemed impossible. One of my favorite strategies has always been to focus on businesses with durable competitive advantages. These are companies that, for reasons that are not always obvious to the casual observer, consistently outperform their peers over long periods. They have strong brands, unique products, loyal customers, or operational efficiencies that make it difficult for competitors to gain ground. By identifying such companies and holding them for decades, you allow the power of compounding to transform modest investments into substantial wealth. It's also important to recognize that mistakes will happen. No investor is perfect. I have made countless errors, buying a company at the wrong time, overestimating growth, or failing to foresee market changes. But the key is not to panic or to let mistakes define your future. Instead, analyze them carefully, learn from them, and adjust your approach. Over time, the accumulation of small, thoughtful corrections leads to success, while hasty reactions and emotional decisions lead to failure. The psychological side of investing cannot be overstated. Greed and fear are constant companions in the world of finance, and they are often more powerful than any market force. When the market is soaring, it whispers, "Everyone is winning, you must act now." When the market crashes, it shouts, "Sell before it's too late." But the wise investor listens to neither. Instead, they trust the fundamentals, they trust their research, and they trust time itself. Wealth built slowly is a reflection of disciplined thinking, not of chasing trends or headlines. Diversification is another tool, but it must be applied intelligently. Owning a broad array of mediocre investments is not the same as owning a few excellent businesses wisely selected. True diversification protects you from unforeseen events without diluting your potential returns. It's a delicate balance between spreading risk and concentrating on what you understand best. And the more you understand your investments, the more confident you can be in concentrating your capital where it will do the most good. Charity and generosity also play a role in the philosophy of wealth. Money has a purpose beyond personal comfort or luxury. It can empower others, create opportunities, and build a legacy that outlasts your lifetime. I've found that the discipline and patience required to build wealth are the same qualities that make philanthropy meaningful. You give thoughtfully, with the same careful consideration you apply to investing. And in doing so, you create a life that is richer than numbers alone can capture.
Over the decades, I have observed countless investors who are always chasing the next big thing. They move from stock to stock, fund to fund, idea to idea, never settling long enough to see the full effects of their choices. They are constantly reacting to the market's noise, to headlines, to speculation, and ultimately they rarely achieve sustained success. The lesson is clear. Wealth is built not by reacting to every market twitch, but by making deliberate, informed choices and letting time amplify their results. Time, in fact, is perhaps the single most powerful ally an investor can have. While many fear waiting, I have come to embrace it. A business does not grow into greatness overnight. Earnings accumulate slowly. Dividends are reinvested, and small, consistent gains over years turn into extraordinary outcomes. Patience is not passive. It is an active commitment to staying the course, to continually learning and reassessing, to understanding that meaningful wealth is a marathon, not a sprint. It is equally essential to maintain a circle of competence. I have never claimed to understand every industry, every trend, or every fad. What I do know is where I can reasonably assess value and predict outcomes. By staying within this circle, I reduce unnecessary risk and increase the likelihood of success. Investing outside what you understand is not adventurous, it is speculative. And speculation is not the path to slow, reliable wealth. Financial freedom, achieved through this disciplined approach, is a profound reward. It allows one to make decisions free from pressure, to focus on what truly matters, whether that is personal growth, family, or contribution to society. Many people equate wealth with consumption. Bigger houses, flashier cars, more possessions. But true wealth is measured in security, in choice, and in the peace of mind that comes from knowing your financial house is in order. Let me speak for a moment about risk. Risk is not just the chance of losing money, it is the chance of permanent loss. Temporary fluctuations are irrelevant if your investments are sound. By understanding the underlying businesses and their ability to generate profit over decades, you reduce your exposure to permanent loss. This principle is why I have often advocated buying companies with strong balance sheets, predictable cash flows, and a history of prudent management. One must also understand the virtue of simplicity. Overcomplicating investments, seeking exotic opportunities, or chasing complexity rarely leads to better outcomes. I have found that the best results come from clear, understandable businesses with straightforward economics. If you can't explain how a company makes money in a few sentences, it may be best to look elsewhere. Complexity does not equal safety. Clarity and comprehension do. And finally, remember that wealth is cumulative. Every dollar saved, every share held, every informed decision compounds over time. The process is slow, often frustratingly so, but it is also inevitable when approached correctly. There are no shortcuts, and those who try to take them are often the ones who fail. Wealth built slowly is wealth that endures, wealth that survives market cycles, and wealth that can provide for generations to come. One of the most overlooked aspects of building wealth is consistency.
People often underestimate the power of making the same good decisions year after year without interruption. It is not the occasional brilliant move that accumulates wealth over time, but the relentless application of sound principles. Saving consistently, investing wisely, avoiding impulsive reactions, and learning continuously, these habits compound just like money does. They form a foundation that can carry you through decades of market highs and lows. I often remind people that the world of investing is filled with stories of short-term heroes and long-term failures. Those who chase the next big trend may achieve fame for a moment, but fame is fleeting. True success is measured over decades, in steady progress, in decisions that may seem ordinary at the moment, but yield extraordinary results in the long term. It is far more rewarding to quietly build wealth than to chase recognition or quick applause. Another lesson that cannot be overstated is the importance of understanding human behavior. Markets are driven by human emotions: fear, greed, impatience, and overconfidence. By observing these emotions, rather than being swept away by them, you gain a tremendous advantage. When others panic and sell, you have the opportunity to buy quality assets at discounted prices. When others are euphoric, you exercise restraint, ensuring that your decisions are guided by reason rather than excitement. The ability to remain calm, rational, and disciplined in the face of emotional tides is a hallmark of successful long-term investing. Taxes and fees are also factors that quietly erode wealth. Many investors fail to consider how much of their returns are lost to unnecessary costs. Keeping your investments simple, minimizing transaction fees, and taking a long-term approach reduces these silent drains on your capital. Remember, every dollar saved from unnecessary expenses is a dollar that continues to work for you, compounding quietly over years. It is also important to view wealth not only as a personal achievement, but as a tool for responsibility. The money you build allows you to support family, invest in communities, and contribute to causes you believe in. The discipline and patience that accumulate wealth are the same qualities that make your contributions meaningful. Using money wisely enhances both your life and the lives of those around you, creating a legacy far beyond simple financial success. Let me tell you about the importance of learning from others. While experience is invaluable, observing the successes and failures of others accelerates understanding. Study companies, read financial statements, listen to insightful minds, and absorb lessons from history. This does not replace your own judgment, but it enriches it. The greatest investors are those who continually expand their circle of knowledge while remaining humble and cautious in their actions. Finally, it is essential to embrace the reality that wealth grows slowly. The temptation for quick wins is always present, yet the greatest fortunes are rarely the result of luck. They come from steady accumulation, careful study, disciplined investing, and patience over decades. There are no shortcuts. Every dividend reinvested, every sensible decision made, every small improvement in understanding compounds over time. This is the path of slow but guaranteed wealth, the path that transforms modest beginnings into extraordinary outcomes.
As we reach the conclusion of this reflection on building wealth, it is important to remember that the journey is as significant as the destination. Wealth is not merely a number on a statement or a tally of assets. It is the product of disciplined thought,
patient action, and a consistent commitment to principles that stand the test of time. Every decision you make, no matter how small, contributes to this accumulation. And over decades, these choices coalesce into something substantial and lasting. True wealth is not measured in a single year or by fleeting market highs. It is measured over decades of careful planning, thoughtful investment, and unwavering patience. The investor who understands this does not chase trends or react impulsively to every market fluctuation. Instead, they cultivate an understanding of value, a respect for time, and an ability to see beyond immediate gratification. This is how fortunes endure, quietly, steadily, and reliably. In the end, building wealth slowly is not a compromise. It is a strategy rooted in reality, wisdom, and respect for the forces that govern both markets and human behavior. By adhering to principles of simplicity, discipline, patience, and informed decision-making, you place yourself in the rare category of investors who not only preserve capital, but grow it meaningfully. The path may seem slow, sometimes uneventful, and often tested by doubt or impatience. Yet those who walk it faithfully are rewarded with something far more valuable than rapid gains: financial security, freedom of choice, and the confidence that comes from knowing you have acted wisely. Remember, wealth is cumulative. It grows from the disciplined use of time, knowledge, and capital. Every reinvested dividend, every informed decision, every small step taken with care contributes to a future that is secure, stable, and capable of enduring both personal and economic challenges. And perhaps most importantly, wealth built slowly is wealth that can be shared, used responsibly, and passed on, creating a legacy that reflects thoughtfulness, prudence, and foresight. So, if you aspire to wealth, let it be the wealth of patience, understanding, and steady progress. Avoid shortcuts, resist the lure of instant gratification, and focus on the fundamentals that endure. Let time be your partner. Let knowledge guide your decisions, and let discipline shape your actions. In this way, wealth is not only built, it is guaranteed, slowly but surely, the way nature intended, the way experience teaches, and the way true investors have always prospered. And in the quiet of decades, when you look back, you will realize that what seemed like a slow journey was in fact the only path to lasting success. A path where every prudent choice, every thoughtful action, and every moment of patience has compounded into a life of security, freedom, and enduring prosperity.